Hello, everyone. Welcome to the property page walkthrough with our VP of Investments, Cameron Wu. Cameron, wonderful to have you here today. What are you sipping on this morning?
Well, thank you so much. Great to be here. I am sipping on Waterloo watermelon.
Love to
Delicious.
hear it. Well, and for everybody on the line, this is different than our traditional webinar where we walk through more of the 101 on Arrive. Today we'll be focusing in on the property pages and all the different details. As mentioned in the chat, we would love to hear where you're tuning in from. We'll also have Jake, our business operations manager, in the chat, as well as a whole host of other folks from Arrived as well, listening to your feedback, asking questions. We'll be dropping polls. I know our director of product, Alexa, is also on the line as well as a whole host of folks. So Cameron, if we want to get things started, I know you had a property that you wanted to walk through. So we'll kick it off there.
Yeah, sounds great. Well, thanks so much for joining, everyone. And I wanted this to be very interactive. So as we go through the property, I'll give a high-level overview of what we will be talking about. And then from there, please go ahead and submit questions. Corinne does a great job of moderating, so she'll be sure to stop me with any questions that are pertinent to what we're discussing. There's also polls that are going to be shown throughout the presentation. So please stay interactive. We're building for you. So let's get that great feedback so we can implement that at the product level. And you got the best person on the line, Alexa, who's our director of product, who will be reviewing a lot of the feedback. All right. So let me share my screen here. Window.
Should have kicked us off with some music in here, Cameron.
Maybe some country music for the Dolly in Nashville, Tennessee. All right. So this is an Arrived property page. Many of you are probably familiar with it, but on the top left, we have an Invest tab in which you can see all of the properties that are available for funding, as well as prior ones that have sold throughout the illustrious Arrived history over the last year and a half or so. So at the top of the property page level, you got some great photos here and some basic attributes such as the bed, bath, square footage, the year it was built, economics of it, so how many investors there are, the purchase price, the monthly rent, a description, as well as some leasing information, expectations of economics based on the market returns over a 20-year history. Some more information about the market, Zillow home price trend. So it gives you an idea of from the lower points in the market in 2011 and 2012, what has it done over the last 10 years or so? Offering details, these are specific to our Arrived process of offering kind of house IPOs to the public, the purchase price, what we do with the money with the property improvements and cash reserves, closing costs, offering costs, and holding costs, those are related to the transaction. So as far as acquiring the properties and closing on them, transacting them. And then finally, our sourcing fees, which are part financing costs as well as for the labor cost of acquiring and securitizing these properties. And then from there, we have more economics and disclosures on the SEC website specific to the property. So if you were to click any of these links here, they would take you specifically to the SEC filing for the Dolly. And we'll go into those in more depth over time. And then common questions, which are links and just basic info from kind of our most asked questions surrounding the investment. So with that, that's kind of the high level overview. I didn't know if there were any questions or polls that you wanted to go through, Corinne?
Yeah, it looks like we're just dropping the polls as we go. We had a question about submitting properties to Arrive, so I saw Jake was able to enter that in. I think one thing that could be beneficial to walk through, Cameron, really quick is within the fees section, perhaps a high level overview of fees would be wonderful. And then how those numbers apply to an investor. Like if I was to go invest today, how do those impact me?
Got it. Under the offering detail section, we have arrived sourcing fee one time, and in this case, it is 36,210. So the way the sourcing fee works at Arrived is that there's kind of two components to it. One is the labor involved in the sourcing of it. So it's identification of an investment all the way through the process of securitizing it with SEC, where we have to have kind of a full game plan. And numbers packaged up to meet the SEC's requirements. And then there's also a financing cost in there. So Arrived, the company, purchases the property first, gets it through the diligence period, gets it through rehab and really up to a rentable state. And then from there, when it is sold to the investors, then we exchange the money and then Arrived gets paid off. So there's both a financing component as well as the, and that's just the cost of capital. And then there's a labor sourcing fee, which helps keeps, the lights on at Arrived. The other is a recurring assets under management fee, which is 1% of the equity that is raised at the time of the investment. So that is drawn out after all of the rental operations, and that is a 1% asset under management fee charged per year. That's not part of the offering details in this number, so it won't be reflected here. It'll be reflected in the quarterly financial reporting for the economics of the property.
Wonderful. Yeah, I saw Jake was able to tackle a few questions around the management fees as well. So appreciate you walking through that, Cameron. I know we have a few others popping through here. Do you want to continue to walk through, or do we want to answer these ad hoc? I'm happy to go either direction.
Yeah, we can continue to go through these ad hoc. Let's just
Perfect.
make it live.
Sounds good. There was one on hold period. I think we include it in the offering details section, but can you walk through what the expected holding period for an investor might be? When and how can an investor cash out? And what are the fees to cash out? So Cameron, I think first and foremost, our hold home thesis, the 5 to 7 years, why we have that in place. And then number two, perhaps you could walk through liquidity and what options we have coming down the board.
So the anticipated hold period is 5 to 7 years, and there's a couple of reasons for that. Real estate, especially single-family residential, has proven to be a very steady appreciator over time. So 5 to 7 years tends to be a kind of medium-term horizon where you can see a cycle for some meaningful appreciation, but there are transaction costs. So when you sell real estate, somewhere in the neighborhood of 6% gets taken out as broker fees, as closing cost fees, title, escrow, taxes, prorations, etc. So those all drag returns down a bit. And 5 to 7 years is not a hard and steady rule. They're more guidelines in terms of the investment thesis. If we find that it's not a favorable environment to make a sale in, we're not going to have to affect that sale. We can hold for a more optimal time period. And we would do so and keep operating it as a rental. So that's kind of some context on the 5 to 7 year hold period. As far as liquidation options and liquidity, which really just means the ability to exchange cash for an asset, so your security in the home. Right now, we are in the later stages of getting SEC approval for a redemption program. So that is where Arrived would provide a fair third-party valuation of the shares. And we would then be able to exchange your shares for that quarterly updated value. So once that it gets approved, then we'll be able to offer that redemption program. And we certainly encourage you to hold for the full 5 to 7 year investment period. But we're trying to make a really great retail investment product, and life calls sometimes and you need the cash. So we're looking to make it the most accessible real estate security that there is. You think about the traditional way of having liquidity options if you held real estate. And there's usually two ways. You can either refinance it, which in today's environment wouldn't seem super favorable, or two, you could sell it. So having a intermediary option of liquidity through a security is certainly a retail investment experience that we're really hoping to connect with real estate.
Awesome. Thanks, Cameron. We had a question here. Can you zoom in on your screen, Cameron, by chance? Just so we can view it a little better. I got to get my spectacles out. Perfect. We had a question on that in the chat. And then Cameron, I did see a mention about, like, in the summary, obviously we have like the number of investors, purchase price, monthly rent. If you scroll up a little bit right at the top, the question in here, and great feedback, is around tenant status. So Cameron, as it stands today, within our tenant status all the way at the top of the screen, we have either vacant or rented. Can you walk through kind of what our typical process is for getting a renter within a home? And then also, I think that's awesome feedback for Alexa and the rest of the team to hear about kind of why that's important. So the rental status, if you'll just walk through that briefly.
Sure thing. From the time that we acquire a property, there's a couple of different variations in timelines that you could see. Everything goes through a rehab process. And even though we try to buy as close to turnkey and ideal homeowner occupied condition as we can, there are always improvements that are needed to be made before it goes into a rental operation. So our property management partners evaluate for that. And then we go through kind of an extensive review process, budgeting process to determine whether the improvements are really necessary. So trade labor has been difficult to find. So I would say that our rehab times are certainly running longer than I would typically expect. But in general, a lot of our properties are performing within a 45-day from purchase to leased status. I think that there are certainly properties that do require more extensive rehabs, and we try to allocate for that in the cash reserve process. So we raise cash reserves to get it through the vacancy cycles for more extensive rehabs if we need to do things like replace flooring, replace building a new fence or something like that. So we try to be mindful of that in the cash reserves. And then from that point, we go into leasing mode, which can be fairly seasonal depending on which type of asset that we're operating. So larger homes that tend to be in better neighborhoods at a higher rental point, we want to make sure that we lease it in the spring and summertime. That's when the households who are looking for that type of asset are in the market for getting a rental home. And then in the fall and winter seasons, it tends to be slower. So we're aiming more for assets that are a little bit more rentable throughout the year. So that can take anywhere from 15 to 45 days during the spring and summer season. And then from 30 to 60, I would expect for most homes to get leased in those slower seasons. So, 1 to 4 months is what we would expect as the initial vacancy. And one of the major goals is to really make sure that that's the only vacancy cycle that we ever have in the investment, the whole investment holding period. We opt for 2-year leases as our default way of renting out properties. We're looking for tenants who are committed to the neighborhood, committed to renting out the home. So we're really filtering out the one and done type renter. Vacancy cycles and just going through a turn and a releasing process, that's really going to kill the cash flow, because we're not going to be generating enough cash flow in that 5 to 7 year period. If we're constantly having to turn it every year, or like an apartment, that just doesn't work very well for the single family rental model. So we do bias towards those longer term tenants. And that is part of the reason why it also can sometimes take longer to find tenants in the initial vacancy period. But if we can get somewhere around the 4 to 5 year average rental period, we'll be doing really well as far as industry averages go. So that's some strategy and context behind how long it takes to rent out a property and kind of what you do. And I can go into more detail if there's further questions about the process of doing so.
Awesome. Thank you, Cameron. That's a wonderful question. Apologies, I missed to ask that. But if you have other ideas on what would be helpful in that rental status, definitely let us know. Additionally, as we're going through here, we'd love to hear what is most helpful on property pages, what other information you wish you had, and perhaps if there's any areas of opportunity, like if something's confusing, keep us honest. As Cameron mentioned, we're building for and by you. So if we can make any improvements to help communicate more effectively, we're 110% all ears. We had one come in from Susan around mortgages, LTV. Can you walk through, Cameron, does Arrived have properties with mortgages that are included? Where can we see whether there is a mortgage and what the LTV might be?
Yep. Arrive does have properties with mortgages on them, and we've kind of been swinging with the market. So in our first 70 or so properties, they all had mortgages on them. And then as financing rates started elevating, then we were, simultaneously hearing from our investment community that they were wanting properties with no mortgages, that it would be a truly crowdfunded investment home. So we started offering properties with no financing, and then we started hearing feedback saying, "Hey, where are the finance properties?" So we're triangulating on a pretty healthy mix of properties that will include debt, and we're constantly looking for those. So as far as where you would find that in the property pages, as you go into offering details and property loan amount, it'll fully disclose the capitalization structure of the investment. And that's just a way of saying how much is debt and how much is equity and what are the funds used for. So there's a lot of great information within the offering details that disclose the property purchase price, where if you were to go to the property page, then you would see within the sale history that, indeed it would be the same price passing through. So that's where all that disclosure is for what the funds are used for. And you would similarly see property loan amount right here. So in this case, the Dolly does not have financing, but it would be here.
Awesome. Yeah, we just dropped a poll on what you would prefer, leverage, non-leverage. So we would love to hear from you all on that poll. There was another question on ROI. So Cameron, if you could walk through, if you could just scroll to where that calculator is, we do have an option in here for a calculator. We'll be changing that section soon. It's just below. Yep. Perfect. Calculate your hypothetical returns. But can you walk through, Cameron, how much ROI can investors expect in the first 5 years?
Sure. So the default values on this calculate your hypothetical returns tool here is the historical market average over the last 20 years, according to Zillow, so 4.6%. And then the rental income similarly is also based off that same data set, giving that historical rental yield. So between the 3.6 and the 4.6, over a 5-year holding period in which we fully sold the property, then you would have an equity return of 2.9% with all fees and all transaction costs involved, and then a 3.6% return annually on the dividend yields. So the sum of those two is 2.9 and 3.6, which would be 6.5% annual over a 5-year period.
Awesome. Perfect.
And then if you wanted to play with the assumed property return average, then this would be 9, 10%, et cetera. You would see the property equity returns shift.
Wonderful. Yeah, and I know we have quite a few resources on historics as well, so that we can drop in chat if Jake hasn't already. So I will throw those that way. I saw 2 flow in from Bob and Tara that kind of go in tandem. So I'll start with the first one, Cameron. Most of the properties appear to be needing a cash flow of 2% or so of the total property amount. Is that the current average?
No, it currently is higher than that. We look to be conservative when we're estimating our cash flows and want to return in excess of that. Additionally, one thing I'll mention about the way returns are presented is that often when you look at other sites or just investment returns. A lot of those metrics don't present the fully burdened investment in the sense of needing to have cash reserves. And all of the additional costs that were incurred at closing and financing to be part of the basis. So when we present our numbers, they are fully burdened numbers in the sense that we're even including the cash reserves that are being raised as part of the investment. So even though it's not being deployed in the house, that it is still, part of the returns, right, that we calculate. So yes, 2% is kind of a minimum cash flow target that we look at preserving just to make sure that it is a cash flowing investment. And we are extremely well covered with respect to finance properties as well. So usually it dips down into that 2% when we're also supporting a mortgage payment. But of course, we invest in properties with mortgages, even in a higher interest rate environment, because you want that levered equity appreciation. I'm happy to go into that later if there are questions about that, because there's always a nice question or two about that. So yeah, I think that our historic performance is more in the 4 to 5% range in terms of what ends up actually cash flowing. We're still early in the life cycle, so operating rentals is usually a capital intensive upfront exercise, right? You purchase the property, you incur vacancy cycles, you have property tax bills and interest and utility payments that are accruing all throughout. So when you do finally get that tenant in there, then the performance normalizes over time. So we replenish the cash reserves, we pay out the dividends. And then if we do meet and exceed the vacancy targets and get a 5-year tenant, then odds are that you're going to be really outperforming the expectation. So we'll see, but we definitely have a good operating plan in place. And over time, these investments should get more profitable in terms of higher effective cash flow, because all those initial upfront expenses will have been kind of covered and replenished.
Definitely. I see a ton of questions flowing through that I'm getting excited about. Before that, there was another question by Tara. Under the first dividend yield, is that the expected percentage for the dividend to be received by the investor? So this is in tandem, Cameron, with kind of what we were just talking about. So the higher that the percentage, does that mean that the dividend is also higher as well? They made a comment about, seems we would want to find the properties with the highest dividend yield out of the bunch.
Yeah, that's definitely a good strategy as far as maximizing the expected cash flow from the returns. I think that there are properties that could potentially outperform high dividend properties if they appreciate more, especially if they have leverage. It's certainly more of a risk in the sense of trying to maximize the gains, if you go for a lower yielding property, because you're expecting that the value will go up over time, which it may way outperform or it may underperform the rental income possibilities. I think that single family residential is very much a balance of both. It seems that half the returns come from appreciation and half the returns come from rental income. So it's a pretty good, well balanced, traditionally, what we would consider both cash flowing and a good protector of value. Not only does it appreciate, it tends to at least retain its value, even if it's not growing and beating the market, probably at least keeps up. So there are other residential assets that are higher cash flowing that we're looking into right now. Some of that includes different slices of residential housing, like retail workforce housing, as well as just smaller multifamilies. Those could be similar to the single family residential operating thesis. You could use similar resources, but they're going to be revenue denser because you could have 4 income generating units in a similarly sized residential lot. But with SFR, I would look at it very much balanced and a safer place to put your money, in times of volatility, because that is kind of the thesis, is that it retains its value over a longer time horizon.
Definitely. And Cameron, you just talked about different asset classes. So we dropped a poll. We are currently in single family homes. We'll be moving to vacation homes Airbnb style in the near future. If you would like to see another asset class, definitely write in the chat. We're all ears on that as well. Cameron, there was a question from Mingzu on risks in particular, which I think is great to cover. We do have a document too, all the way at the bottom in terms of risks, but can you walk through essentially high level the main risks of investing in Arrived as a whole?
Yeah, let's talk about the biggest risks is what could you lose financially? And the answer to that is your equity investment, right? It's a simple answer. So what it also implies is that you're not liable for the debts of the organization. So when you're investing in a property in Arrive, you're purchasing a company that holds the real estate. So you're while you're also purchasing that company, you're not purchasing its liabilities because they are non-recourse. So any debt that's taken out is non-recourse. And it's very much like owning a public market stock. So let's say you own a share of Apple. You're not liable for any of Apple's risks or any lawsuits or any liabilities that they may be found guilty of. You as a shareholder are just have an equity interest in them as a company. So it's very much the same as Arrive, that you're getting a company that is backed by the value of the real estate, but you're shielded from any sort of operating liability, any sort of debt liability or debt obligations that need to be repaid back. You're only ever liable for your equity investment. And much like Apple stock, if it ever went to zero, then you're out your initial buy-in. Similarly, if a house and its land, for whatever reason, somehow went to zero value, then of course you could lose out. And with debt, it's a bit of a different conversation. But in terms of an equity investment, it is backed by that real estate. So that's what you could lose financially. And then from a other risk factors point of view, we could talk about the investment side, which I kind of covered in the first answer, but it's more along the lines of, would you have any sort of personal liability with respect to operations of the asset in the landlord tenant capacity, or anything that arrived the company? Would you be liable for anything that we do as a manager? The answer is no. So that's investment risk factors in terms of like holding the security and you personally as a liability. In terms of whether it economically performs, there's all sorts of risk factors. This is really kind of market risk of having an investment. So I explained mechanically what you could lose and kind of the separation of risk there. But as far as does it appreciate or not, certainly there are a lot of risk factors in whether it would appreciate. We could see prolonged recession and stagnation for a long time. As a country, any country could. So nothing is guaranteed in the sense of economic performance, but mechanically, what I kind of talked about in the beginning, those are some of the dynamics of what protect your investment and how it's properly de-risked in a lot of ways. Economic performance, we could talk all day about risk factors.
Sure could. I'm seeing some great feedback in here about choosing a property based off returns. Cameron, for our platform to date, can you walk through kind of the strategy that you look at when you're choosing a home to invest in? This is more like Cameron's experience, because we had feedback around somebody that's, I think Juan wrote, had mentioned they scroll through, they're looking at the expected appreciation, total return expectations, region, all these different factors that I know in the future we're working on filtering, but would love to hear from you on what your thoughts are.
Yeah, I tend to think macro first and then micro. So pick the market, and then once I'm in a market, then I try to pick the asset that I believe will appreciate. I think that rental income is always going to be there for SFR, but it's not necessarily what I'm looking to maximize for my own personal goals. So I think which market is both undersupplied and overdemanded. And if it has that dynamic, then I like it as a market. Then from there, I might pick the best looking house. Because if we're going to be able to sell it to the open market in 7 years, we will get a good price from a homeowner, more than likely, more so than an institutional buyer or any sort of other rental operator, because they're going to buy it for a cash flow, not necessarily its livability. But I think we've picked really pretty homes that are nice to live in. So an owner occupant may give us the best price. And with that said, I think, picking pretty homes is actually a very important part of getting an investment correct when it comes to single family housing. But really, it's also what is the right way to look at an investment given your appropriate time horizon. So if we're thinking 5 to 7 years and, hold it for good income and then sell it opportunistically, then, I have one set of criteria. If we're looking at multifamily, then it might be extremely number focused and operating efficiency focused. And that's where we would make our juice and make that juice worth that squeeze. So for me personally, market first for over demanded and undersupplied dynamics, and then pretty homes. And then I also like homes that are always in demand. So a home that is 4 bedrooms and 2,000 square feet is just like a perfect range to be very accessible for so many people. And those I find to be in demand configurations that attract the market. So I'm always looking for like overly demanded things. And that's just a way to protect your price and look for rents. So in general, I would give that general advice in anything. Anytime you're looking at any kind of asset, see if, just look for the overly demanded items, and then that's where
Definitely.
I invest.
I know I'm a sucker for those great finishes in the Dolly. One wrote followed up here with a great question. And apologies if I say any names wrong here. Keep me honest in the chat. The Dolly and the Kenny, Cameron, are right next door to each other. So if you were to log on today, what would be your differentiator that you can recommend, or perhaps the difference in these two properties when investing? I thought that's a great question.
Yeah, that is a great question. And I would say that the biggest difference that I see, it's the same builder, it's the same lot split, but the Kenny has an extra half bathroom. And I think that may really make the difference for people. But I think the Dolly has really nice finishes, like really stunningly nicer finishes. So both are kind of equal trade-offs in my mind. I think one other big consideration though is that who are your neighbors? So on the Kenny, we have an older house here, but this whole street is being built up. If you go check out the address, which is right here, 1843 Mead Avenue, you'll see a lot of new construction everywhere. So I don't think that this is going to be a long-term neighbor here. But if you look at the Dolly, it's empty right now. Doesn't mean that there doesn't end up being something there in the future where whoever the lot owner is, they may develop it, and it may be residential zoning as well. But you have one new house that's a neighbor and it's fenced, and then you have nothing. So if it were me buying the house, I would, prioritize that highly as the Dolly. Plus, it's got the finishes I like personally. But the Kenny does have more square footage and an extra half bathroom. And that's not, that's not something insignificant to have a guest bathroom, like to have guests not have to go into your own space or your family space. Like, so that's certainly an underrated aspect of, having that extra half bath. Different folks will have different opinions. So I think they're pretty close in my mind.
No, love hearing that, Cameron. And you made a good point when we're talking about like comparing one versus the other. And I believe the monthly rent for both of these properties is the same or close. Can you walk through? I know sometimes we go over asking rent. Can you walk through what that would mean? Like if we showcase a leasing email and it went for 300 over the asking price. Can you walk through why that might be?
Yep. When we advertise our rents, we we try to be conservative as well, because we want to feel confident that even at a particularly advertised rent, that you feel good about the economics based on that. So, if you were to buy a 690K home and fund it with all the necessary equity, do you feel good about a 38.95 rent? Then we try to overperform when we take it to market. Sometimes we're going to be able to, because the seasonality is just hitting correctly. Other times it'll be more challenging because we're going to be going into a season where we need to lower rent to make sure that we're not hitting a slow season. So we generally take an approach of conservatism just to make sure that we're meeting expectations. But that is what happens. You get the full pass through. So even though we advertise $38.95, if it ends up being $39.95, then that's just an extra $100 per month cash flow that goes towards the company that holds the real estate and then distributed to the shareholders.
Great. And I know Kimberly just popped in with a question. So the monthly rent is your goal, but may not be the exact amount that you actually get.
Yes, correct. And we do try to get more initially, test the market. And if the thesis is off, then we try to hit that. And quite candidly, it might even be below that, because if we're off the mark on the rent, the market has just, it has spoken in a sense. So we do everything we can to try to get the right economics, and we operate it just as if it's our own personal rental homes. That's kind of the philosophy of decision making. But sometimes, the market just has a different idea than we had of our asset. So it can be above many of the times, but just know that it can be lower as well.
Definitely. And I know Everett just popped in with a question that relates. Do rent amounts by market traffic and scheduling to maximize rent capturability or rent adjustability? Can you walk through that, Cameron? Maybe walk through how we syndicate these listings as well. I think that would be helpful.
Yeah, definitely. So from a marketing front, we utilize our property managers who have contracts with the largest syndication platforms for rentals. So it ends up on Zillow, it ends up on Trulia, Realtor.com, Redfins, all of the major listing sites where you would expect to find rentals. So that's one aspect of it. The other that may have been implied in the question is how we're capturing market movement and seasonality. Maybe is a little bit more of the question. Our leasing strategy is very intentional about making sure we don't have exits in months that we don't want them. Let's take a very slow leasing season, for example, like November. If we happen to rent a property at the beginning of November, we're really not wanting to have that lease expire on October 31st or end of November. The reason being is that we're still in a very slow season for leasing. We want to get our assets back when they are easier to lease. So we don't accept any sort of lease expirations, or at least this is one of our more recent policy implementations on behalf of all of our investments that we manage. We don't have expirations between June 30th and February 28th. I mean, they can start expiring at the end of February, beginning of March. And the reason being, it's like, okay, maybe we have an 18-month lease instead of a 24, but that's fine because it gets me into a season where I will take the risk of a lease expiring because that person just may need to vacate. That household just, they no amount of compromise or willingness to work with them can save them. They just have to move. So we don't want vacancies during seasons when we don't want them. And that's something that we're implementing portfolio wide. And it's, again, part of the leasing strategies to just try to maximize the cash flow. And if we do take on a vacancy, we'll be glad that we have it back in April instead of November.
Wonderful. I know, Cameron, you had walked through kind of like our cash reserves, how they're allocated. In your prepared remarks in our traditional webinars, we talk about like not having to worry about the 3 T's, taxes, trash. I'm missing one. I'm thinking tenants, all those different pieces. Toilets. There it is. Thank you. Clearly, And
Can't
clearly, I
forget
don't
that
want to
one.
worry about them either. But I think that we had feedback from Neil around understanding those improvements that perhaps take place per property and how much we're spending in 2022. Can you walk through perhaps an average? And then as a side note, Neil, I think that's awesome feedback in terms of figuring out what we would want to share. So please keep us honest in the chat. If there's specific things that you would like us to outline in the future, we're all ears.
Yep. Some of our initial properties were on the lower end because we were buying very close to turnkey. So lower end in the sense of they required less expense. So I would say that our average property expense was less than $5,000 for the first couple of properties that we did. And then later, as we started expanding more of our buy box, we were buying assets that were out larger, that were built, say, in 2008 instead of 2015. Those started getting more expensive because embedded in their price was the need to fully repaint the interior of the house. And it's not a big deal. It's actually probably pretty worth it because it's a good way to really sanitize and freshen the whole house is to just fully repaint it, put a new layer on. And when we do those, the property improvements do tend to increase. And another thing that we've also been doing probably in the last 2 quarters is really having a proactive fence initiative just to make sure that we are putting fences in all of our houses that can reasonably support them. And by that, I mean a rent that's high enough on a lot that is reasonably sized enough and not just massive, because that gets quite expensive pretty quickly. As long as it's meeting those conditions, we are making the proactive decision to do that. You get the rent back, you get the value back on sale. It just makes sense. So it increases the price. So we have been spending more majorly on rehabs, full paints, fence initiatives, as well as carpet replacement and flooring replacement with the LVP material, which is competitively priced as well as probably the most durable and decent looking for houses. So those are some of the major items that we do, but to the extent that we can find a way to bucket these expenses and describe them so you know what you're getting in a more renovated house, I agree that that would be helpful. And as we work with different property managers, we're also trying to develop an internal arrived language and an internal arrived product to be able to describe the rehab process, because we're getting it in kind of different verbiage and different data and formats from different partners. So we'll have to work on that part, but I do like the thought.
I do as well. So thank you, Neil. Definitely appreciate it. There was one in from Estelle. And Cameron, when you purchase a home, kind of understanding if we're overbidding or getting the best deals, in the sense that what would happen if the market crashed, et cetera. So can you walk through how do we know comps and if Arrived is buying at a good price?
Yep. Yeah, it's an interesting question because comps utilize one method to value, they create kind of a market opinion on its value, and rents produce another system of doing, income underwriting. And we do both. So when we look at investments, we're looking at those that satisfy a top tier of income requirements, as well as being a good deal in the sense that if we were to sell it, do we have any equity in it the day that we buy it, right? Did we get it for a good deal? So on the rental income part of it, we do value that, and our team is built around the skill of being able to evaluate rental. So all of our investments team, they are from one of the largest single family rental landlords in the country. And we have really extensive experience underwriting rents all over the country. So that's, one of the key requirements is first making sure that it produces sufficient income, because not all single family residential assets produce rentals income, equally. So we do try to stratify all of the assets and then find those best ones. And then second, we can't be overpaying for it. And there's sometimes discrepancy with valuation tools and algorithms. So for example, An algorithm doesn't handle a rehab and a renovation very well. It's usually going to undervalue it because it can't incorporate the money that was just put back into it until you buy the property. So then it sees like, oh, somebody bought it for what appears to be, above market value, and then it might adjust. But you are going to be the buyer when there is a rehab, and it's going to look like that you paid more for it. So I think including renovations and looking at things that are more turnkey do present some challenges in terms of trying to make it mesh with valuation tools and like comps in a traditional sense. But we have a very human touch to our acquisition process. So we have a saying around here, it's like, let machines do what machines do best, and then let humans do what humans do best. And a lot of what humans do best have to do with visual consumption of information to be able to understand value. So we can see the numbers, we can see the comps, and it is part of every process that we go through when we make an offer on our property. Like, we do grab those third-party valuation reports like House Canaries, and then looking at Zillow and Redfin values, and then other third-party valuation sources. So that's all part of what we do, including the rental income valuation. And then really just has to pass the kind of pretty test with the eye. It's like, make sure it's great, and then that's how we bid on properties. And as far as value goes, I think that even if you're above an estimated value, if you know that it's going to be a great rental investment, then that's another way of looking at its value. So we do it both ways. Definitely.
And now you're talking through one of my favorite parts that arrived, Cameron, is when you and your team are choosing those properties to list on our site and move forward with purchasing. So for everybody on the line, if you'll give us a heads up, if you would like to see Cameron or the team go through live walkthrough of listings, and either give the X or a check mark, that could be a potential webinar in the future if you all would be interested. I see Damien already gave us a thumbs up, so definitely keep us coming. Everett asked, are you assuming 2 turned per hold period? What is the expected turn cost estimate? I think what's great to see here is understanding if this would be of interest to see on our website as well.
Our vacancy period assumes 15 days per year, and on a turn cycle, it assumes that it would take 30 days from move out to another move in. So, well, actually 2.5. So it's actually 45 days. It assumes 2.5 years. So that's how we underwrite vacancy. So that's what you would expect is 15 days per year as a cost that we account for in the rent. So if you do have one tenant, and only that initial vacancy period, then you're going to largely outperform the underwriting expectation. If you did turn a tenant every 2 years, then whether you meet or don't meet the expectation is based on how quickly you're able to get it cash flowing again, and then at what rent. So a couple of factors in play there, but we allocate it as just a certain amount of vacancy. And then the cost of the turn, it's going to be in the neighborhood of about 80 cents per square foot per year. So on a 2,000 square foot home, we're allocating $1,600 per year. And again, in some years, you're going to spend 0 of that. And in some years, when you do have a vacancy cycle, you may spend 4,000 of it and then not have to spend for quite a while again. So it really just depends on what issues come up and what kind of tenants you get. But that's how to kind of estimate some of what those metrics are.
Wonderful. And I think we touched on this earlier, but for everybody on the line, we would love to hear what information is helpful for you on these property pages, and also what you desire to see in the future. As we mentioned, Alexa, our head of product, is here, as well as I believe Ryan, our CEO, is in the chat as well as a whole host of other folks from Arrive. So they would love to hear from you directly. So feel free to have that come through the chat. We are exporting it to take a look after as well. We had a question from Bob, and I think this is a great one. Who pays for lawn mowing, landscaping, and such in our leases, Cameron?
That is a tenant responsibility. During the vacancy period, it is owner covered. So it is coming out from the cash reserves or whatever trailing rent payments that there may be. And anytime that it's not under a lease, then it would be owner covered. Otherwise, it's
Awesome.
tenant covered.
Wonderful. And I know we're coming up. I think we had a few other questions pop through here. Kimberly asked, can you tell me again how to calculate the rent amount? So I believe when choosing a property, Kimberly, keep me honest here, like how that would play a part, perhaps, Cameron, when you're choosing to look into a property to invest in.
Yeah. So as far as actually calculating the rent, so if we had a property that was for sale and we looked into that, then we would look at comps. Rentals are a very kind of local and short-term game. So what's important about a rent is what's immediately around it, the immediate competition. So we look at those and we look at pictures and just kind of use our collective experience of understanding where you should thread the needle on the pricing in your market. There's a lot of different factors that go into it. And it's a whole kind of discipline of what we hire for and what we really concentrate on evaluating. But then once you do know the rent amount, then you do know a way to get to the end cash flow, at least kind of on a stabilized basis where it is a pretty good, well-tested underwriting model that I brought over from my prior work history. So we then use that to determine do property economics work within a certain range of prices that property is listed for, and then from there then we go to offer on the property if we continue to like the way that it looks. But a rent is like the key input into understanding whether a rental home is going to be a properly balanced investment.
Definitely. Appreciate you walking through it, Cameron. I believe we cruised right through all the questions. So keep us honest, Jake, if we missed anything here. We would still love to hear what's the most helpful on the property pages that you're seeing. So we'll leave this open for a little bit. What other information you would like to see in the future. And if there's anything in here that's confusing as you're walking through that, like, I truly don't understand what that means when I'm making an investment, or perhaps why it's on that page. Cameron, I think there's one, I think we kind of cruised over this in the beginning. If you scroll down to like why the documents are of importance all the way at the bottom, that might be helpful for those on the line as well.
Yep, definitely. There are 4 documents. The offering circular, this is like the Mac Daddy main argument or main document on the SEC website. This contains all of the offering information about Arrived Homes LLC, which is the company that sponsors the investments that you all are investing into. And then the 3 other links are subsections of this offering circular that go into, one, the use of proceeds, which is what we described up here, is like how is every dollar being bucketed and then further used and reimbursed within the investment. And then there is the series overview, which describes the property and the assets underneath. And then the risk factors, which I believe is one of the questions that we had gotten earlier about what are some of the risk factors. Then you will find plenty in here. So this is the SEC Edgar site, and this is their kind of electronic data. I won't attempt to zoom in. I can see how crazy it looks on the screen there, but really it's just the risks relating to operating a risky rental investment, or a rental, not a risky rental investment, but a rental investment with risks associated with it. And then there are use of proceeds and series overview. So if we click on use of proceeds, then you can see here acquisition of property improvements, brokerage fee, acquisition expenses, along with all the relevant notes. So that's that part. And then finally, I believe series overview is that one. Yes. So Arrived Home Series Kenny. This is the description of the property, the location, and then a little bit more about acquisition and details about the property. And those are the main sections. Again, they're all part of the offering circular in general, but helpful links to utilize when you're looking at individual investments.
Definitely. Thanks for walking through those, Cameron. I know they're lengthy, but always appreciate highlighting them. We've had some great feedback in here, perhaps about a market spotlight in the future, Cameron, which I know we've talked about, as well as Daniel mentioned wanting to see like different market stats. So average rent, average dollar per square foot, average income, demand on supply stats, all wonderful feedback. We would love a thumbs up if you all would be interested in market spotlights of like why we chose Chattanooga, Nashville, where we're expanding to, so on and so forth. So would love another thumbs up if that is of interest in the chat. I did see a mention of what asset class we'll be moving into in the future. So Cameron, if you could walk through the asset class that we're all excited about moving into in the future, and then perhaps where you see this expanding aside from that.
Sure. We are excited to be bringing short-term rentals to the market. Those are vacation rentals, Airbnbs, and they don't necessarily have to be vacation rentals. They could be kind of visiting office stays. If you go to your home site for a month and work from there, then those could also be short-term rentals. But in general, it's an operating asset class that could really deliver on a lot more income. It is kind of beyond the residential operating model that we're used to with long-term rentals and single-family residential, but a lot of times they use the same underlying asset. So it's a really nice hybrid in having a model that is still backed by the residential assets that we feel comfortable with, as well as having a higher upside on the operating model. So you can do a lot of fun things with short-term rentals. So we're excited about that. And beyond that, smaller multifamily is looking like an opportunity for us to get into higher income properties, as well as workforce housing, which is a lower price point segment of residential housing and really has a mission-based focus with respect to investment and improving communities.
Wonderful. Excited to say the least. I saw one last question in here from Daniel. Would you jump into the STR operations yourselves? Super critical aspect of the STR, and STR is short-term rental. So I should have clarified that first.
Yeah, it's something that we're definitely evaluating because I agree that it's a much heavier operating model. So we want to be very close to the assets. And I think that our model already does account for that. So we have an asset management function, which currently we help make those decisions that are best economically for the investment. So an example would be the fence investment that I talked about earlier. Those are not going to be property management decisions that are typically recommended by property managers. It is really us arrived advocating on behalf of that spend for better economic performance. And we also work with the property managers on a daily and weekly basis to make sure that all of the service agreements are being carried out, that they're really delivering on what the expectations are. So with short-term rentals, we would also be doing the same regardless, having that very hands-on touch with our operating partners, making sure that everything is going smoothly. So you're always going to have that additional layer of management oversight. Whether we become the manager ourselves and hire employees dedicated to the operations, I think is an extremely interesting question, and certainly one that we should look into. So that's where we are in deciding how is it going to be operated. And there could also be both models. We could use outside management as well as have certain properties that make sense to be in-house managed. Not saying we would, but it's a possibility. So yeah, it's something that we're continuously thinking through ourselves right now.
Awesome. I see there's so much feedback around markets people would like to see, asset classes. So definitely appreciate all the feedback. I know we're just coming up on time here as we roll through. Cameron, any closing remarks before we close our virtual door today?
Well, I want to thank you all for being such a great audience. Enjoyed the questions, so thank you so much for coming. And I'll say that personally, I think that market selection is extremely important and having better visibility into that. So that's one thing that I'm particularly focused on right now as far as creating data assets that better support our investors is market spotlights. That's not just descriptive text, but it's also more forward-looking and insightful metrics that you would want to know. An example being, which cities are getting the most highway funding right now? That'd be a nice, fact to know when trying to invest for the medium term, which is what we encourage, medium and long term. So those data assets are coming, and that's a focus of ours internally here at Arrived. So I would love all that to say, I would love to do a webinar with respect to market deep dives and just kind of the markets in general, and then from there we can go into specifics.
Definitely. I think we have so many takeaways today. So first and foremost, thank you for everybody on the line for coming and being so engaged. We appreciate the questions, the feedback. As Cameron mentioned, we're building for and by you, so appreciate it. Cameron, thank you for doing a live walkthrough of the property pages to help everybody on the line understand kind of the why behind why we have all these different pieces and what you personally look for with properties. We have some great takeaways for the future around market spotlights, and perhaps like how you're choosing properties. I can already see it. I'm very excited. So we will definitely take that away, as well as all the feedback that we have. So you do know we do have properties live and to invest on our invest page that you can find right now. If we missed any of your questions, or if you have any outstanding, feel free to email support@arrivedhomes.com. You can also live chat us via that little widget in the bottom right-hand corner of Cameron's screen as well. So thank you all. Jake, also, thanks for crushing it in the chat as always and helping everybody, as well as everybody else on the line and our whole team. So thank you all and have a great rest of your day.
Thank you all so much.